Great. Okay, thank you everybody for joining the PropertyEU subscriber and reader meeting. This is an opportunity for us here at PropertyEU to say thank you for all your support during 2020, to give you a little bit of insight into what our plans are for 2021, and to give you a little bit of knowledge update and maybe some information that you wouldn't have heard from some guests, which Robin Marriott, our editor, will discuss a little bit later on. Just to sort of give you a bit of a background into our situation, we have decided to do this really to reconnect with you, our subscribers, and to, I suppose, provide some background into our year for 2020. It's been a pretty crazy year for everyone, a lot of disruption, a lot of opportunity as well, and a lot of change. So from us, we will go all the way back to February, late February, March, when MIPIM, our sort of key event of the year, was postponed and then subsequently cancelled. Now that for us is a pretty important event during the course of our year. It forms a lot of our commercial and editorial relationships with a lot of companies producing reports that we can write about, and stories that we can gather for the remainder of the year. From that and the decision to cancel that, we acknowledged and we saw that there was a big gap in the market. We noticed that companies weren't able to communicate with each other, and we saw that there was well, in fact, all of Europe was pretty much working from home. So we made a decision to open up our content, that is our PropertyEU magazine, our daily news, and all of our back catalogues to the entire market for free for a period of 6 weeks. It was a decision that we felt was important to connect with everyone in the market, have that live, up-to-date information on transactions, on people movement, on what the hell was going on, who's working where, who's doing what. It was, it was a bit of a risk because, of course, we rely on subscriptions as the sort of the lifeblood of our product. But I think in the end, people with the ability to stay connected to what's happening in European real estate appreciated that gesture, and actually in the end it's had some pretty positive effects on our growth for the year. We're up around 10 to 15% subscribers compared to 2020. So for us, I think it was a net positive result. From that as well, and it's something that I will pass on to my esteemed colleague Jane Roberts shortly, but part of the process of that lockdown, there was a decision from our editorial team to start a market survey, a barometer of what was going on in this market from your perspective, you as the subscribers. So anyone who's on this video today who was part of that and has provided that information, thank you very much. It's been really insightful, and I know, speaking to Robin, he's certainly indicated that it has formed a large part of some of the editorial content through our magazines and our daily news over the course of the past few months. So without further ado, I'm going to actually pass over to Jane Roberts for a bit of insight into the latest barometer. It's PropertyEU Market Barometer 6, and she's got some interesting things to share with you on that. One thing I will say before I pass over is that we do have a number of guests, as I mentioned on the call today, and also the information that Jane's going to pass through. If you in attendance have any questions that you would like us to ask anyone on the call, by all means, please shout out, or actually don't shout out, use the question and answer button at the bottom of your screen there. Hopefully you can all see that. We will endeavour to get through as many of them as possible. I can't promise we'll get through all of them, but we want to, again, get your information and understand what it is you guys would like to hear from our panel here today. So that's it for me. I will pass over to Jane Roberts, and as and when you're ready, Jane.
Okay, thanks very much, Eddie. Yeah, hi everybody. As Eddie said, I'm Jane Roberts. I'm one of the journalists on the PropertyEU team, and I'm just going to take about 5 to 10 minutes now to to go through this 6th market barometer. And as Eddie explained, we've been running these surveys really pretty much since the start of the coronavirus pandemic at regular intervals. And our readers and clients have been very kindly completing them. And it's been very useful, as Eddie was saying, a very useful tool for us to keep our finger on the pulse, really, of what seems to be going on in the market. Certainly one of the important things. So if we could go to slide 1, Eddie, please. Can we get the first slide up? Thank you. Great. So one of the questions that we ask each time is, it's quite a straightforward one, but it's about the level of concern that people are feeling about the impact that the virus is having on their job or their firm, their business. And we're tracking that as it goes. Sorry about this. Sorry about that. We're tracking this as it goes, and the latest one shows that the level was a 5, which is 5 out of 10, where 10 would be being extremely concerned about the effects of the virus on the business. So what we're seeing here basically is that the level was very elevated early on in the pandemic. There was a very high level of concern, and it came down in the summer, and really it's sort of settled at around this level now, and we haven't seen it move much. Perhaps, I suppose, we might have expected that it might have gone down further in this latest survey because of the recent very encouraging news that there's been about vaccines. But I think that's probably, partly that news had only just emerged at the point that people were taking this survey, and of course there's still a lot of elevated risk and concern about the economy, what's going to happen next in terms of potential insolvencies, job losses and so on coming through. Can we have the next slide, please, Eddie, number 2? So we asked a number of questions this time around future market opportunities arising out of the crisis. This is the first one. So this question simply asked people to rank the degree, the extent to which they see opportunities arising out of the crisis, with 10 being a very high level of opportunities and 1 being low. And you can see that the average score this time was a 6. So perhaps a reasonably positive outlook now, bearing in mind the extreme caution we were seeing 6 months ago. We'll come back to this topic in a couple of slides, slide after next, I think, where there's a bit more about this. Can we go to slide 3, please? So this question, we asked respondents if they could pick out just one issue that for them has moved up the agenda. And there are a few to take in here, but if you look down to the middle at the pale blue bar, you can see that's the issue which was ranked by the most people as being the one that had moved up the agenda for them. It's investment and fee income, which I think probably is best interpreted as just, kind of getting on with the day job. And so perhaps, again, that's not a great surprise, but another one which is a little bit alarming, lower down the pink bar, second from the bottom, which is just pure survival. We were slightly worried to see that 7.5% of people out there seem to think that is absolutely the most important thing for them at the moment. So not everybody out there is finding this, you know, this something that they're coping with well. Other issues which came out as important to respondents, you can see at the top there, there's climate change and tech as well, which were both picked by a substantial number of respondents. Climate change in particular and ESG generally is something that we've been hearing, you know, so many people are talking about this at the moment, and it's you know, it's obviously something which is you know, there's a big demand for information sharing on. It's going to be something that will be featuring fairly prominently next year, I think, beginning in the magazine in the first quarter of next year. So could we go to slide 4, please? Thank you. This slide sort of links back to the second one about it's about you know, the level of opportunities that respondents see next year, and this one more specifically looks at the whether people feel that there is a sort of a change coming, if you like, that there's going to be more attractive and heavily discounted priced deals available as we move through into next year. So you can see that more than half actually said that they do think that this is going to be the case, and it's a figure that rises to about 2/3 when you take into account those who strongly agree that there are going to be a significant number of deals at attractive or heavily discounted prices coming through next year. So I think, you know, this is something that, for me personally, in interviews and conversations I've had with contacts in recent months, it's becoming increasingly becoming a topic of conversation. I mean, people are not saying really that they think there's going to be widespread distress in real estate, you know, as we all know there was after the global financial crisis, but that, you know, they are expecting to see some attractively priced, you know, non-core deals coming up, perhaps for the first time really since the global financial crisis. So, you know, we think this tends to support the view that real estate is starting a new cycle, if you like. You know, it's really the first time now since the GFC, you know, that this kind of market is, you know, is on the horizon. Could we move to slide 5, please? So we were interested this time to find out what people feel about the prospects for rental growth next year. We've obviously had a long bull run of rental growth increase in most sectors of the market, you know, retail being a distinctive exception to that. So it's not been absolutely across all of real estate, but you know, certainly other sectors, logistics, offices in particular, rental growth has been pretty good. You'll see from the responses that we had this time that no one expects to see significant rental growth next year, and almost I think that's 3/4, you can see there, don't expect growth at all, or they expect rents to fall. So, you know, maybe this is going to be part of that picture that I've been talking about in terms of a feeling that there are going to be some attractive, some discounted opportunities next year. You know, partly people are going to be revising what they think they might pay, to take into account the fact that the predictions have had to change on rents. And I think, you know, that's something that we'll be reporting about and keeping an eye on closely next year too. So, you know, it's it's also something that is going to have a big effect on existing portfolios and existing assets, you know, with a lot of, you know, pre-COVID business plans perhaps being knocked sideways if this does turn out to be the case. So, you know, I think that's another interesting finding this time. Could we go to the next slide? Thank you. So, yeah, this slide, I think, perhaps shows that a level of realism has set in compared to some of the earlier surveys that we did, you know, in the first weeks and months of the pandemic. We asked this question each time in the barometer, and you know, we're looking to find out what the view is about when our respondents think the market is going to normalise again. So if the early barometers had turned out to be correct, we would actually be in recovery now, or we would certainly be by early next year. And you know, you can see that that's not the case anymore. In this latest barometer, the majority were telling us they think that it's going to be another perhaps 1.5 to 2 years before we can expect to see the market recovering and normalising again. Could we have the next slide? So this slide specifically relates to the news about the progress on vaccines, which was very new when most people were taking the survey for us. And in terms of how much more confident our respondents were feeling, having just sort of got this news when they took the survey, again, out of a scale of 1 to 10, with 10 being feeling it was much more helpful in terms of their ability to take decisions and to do their jobs. The score was a sort of pretty much a 6. And we talked about this. It perhaps seems you might expect that people would have been a bit more confident than that. The score might have been a bit higher, but you know, perhaps it is again really the realization that you know, the immediate decisions are still very difficult, and we're probably in for a tough period, certainly of months, and that, you know, the vaccine, while very welcome news, is not a sort of instant silver bullet that's going to solve everybody's problems, you know, and turn the market round rapidly. Could we move on to number 8? So now this one, you know, this is one of those slides that's slightly perplexing at first glance, I think. We asked people to tell us whether they expect to see stronger or lesser demand for investing in real estate in Europe next year. And you can see we've got pretty much got a 3-way split between those who think demand will stay the same, those who think it will increase, and those who think it might drop off. This is the kind of thing that journalists like Robin and I really hate, because you know, you're always looking for the story in any kind of survey or piece of research, and a 3-way split's not very helpful from that point of view. I think we were quite surprised about this, because, you know, all the talk is very much about you know, how real estate investment is a winner in such a low interest rate, low return environment like the one we have and expect to continue to have for the foreseeable future. You know, you'd think real estate was a slam dunk in those conditions, but perhaps this suggests that not everybody is sure or knows, or, you know, maybe as one of my other colleagues said when they saw this, you know, perhaps there are some investors out there who know something that we don't know. But anyway, it's an interesting one, I think. So can we have the next slide? Thank you. So the last 2 slides, we've just got 2 more, question 9 and question 10, which are, sorry, we've got 3 more. This one, question 9, is about strategies, and again it perhaps links back to the earlier questions that we asked about the expected level of attractive or discounted opportunities that our respondents are seeing in the market or expect to see. So you can see here from the yellow and the pale blue bars that value add and opportunistic actually scored pretty high. So we've got a sort of solid sort of section of respondents there, a group of respondents who still picked core as their top strategy for 2021. Core has obviously been, the story, I would say, during this year. There's been a flight to core. It's been the part of the market which has proved most resilient, during this difficult time. But you can see here that there are also, I think it's 27% who picked value add, and almost 27% who picked opportunistic. So, I do think that there is a bit of a story coming through in this sixth version of the barometer about the kinds of opportunities that people are expecting to see next year. So maybe you heard it here first. The last two, they are questions that we asked about countries and regions and about sectors. This one is the countries and the regions, and you can see at the top there, no surprises probably, that Germany came out as the country which by just about that was the biggest sector of the biggest number of respondents picked Germany, the biggest category here, and with its sort of undisputed safe haven status this year, I think again that's not perhaps so surprising. It's been the country this year that's had the the most resilient, the highest levels of investment. But I think it's quite interesting, you can see down there Southern Europe gets 21% of respondents picks as a region that they're very interested in investing next year. So perhaps that's it's a part of the world that's been obviously hit very hard by the pandemic. The tourism is so important there, and they've had a very rough time. So perhaps that is a region where some respondents anyway think they might see some interesting opportunities coming through. And in the last one, just quickly before I wrap up and hand over, this looked at which sectors our respondents think will attract the most capital during 2021. You can see that very clearly logistics is up there in the #1 spot. Perhaps so far so predictable, maybe. Data centers, build to rent, science parks, they were all picked by a good number of people. But I think perhaps, for me, maybe the story here is the 1, 2, 3, 4, 5th bar down, which is offices. So offices is obviously the biggest sector in real estate for many of our respondents in terms of where they've invested traditionally in previous years. And this time in the barometer, only 7.5% of the respondents picked this as the sector that they expect to attract sort of increasing amounts of capital next year. And in fact, I think only retail and leisure are rating lower there, and hotels rated higher, which I found quite surprising, really. So I think, you know, what happens with attitudes to investing in offices next year is going to be another very interesting story that I think we will be following closely and writing about. So on that note, I hope you've found that interesting and there's some food for thought in there. And I'll hand you over now to my colleague, PropertyEU's editor, Robin Marriott.
Jane, thank you. And thanks for the introduction. Yes, my name is Robin Marriott, Editor-in-Chief of PropertyEU. I am based in London. More particularly, I'm based in my garden shed today, coming to you live from my garden shed, which normally means I've done something wrong. My wife sends me out here when I've done something wrong. I don't know what it is. It's probably talking too much about real estate indoors, which I do a lot of. But what can I say? I love the asset class. So here I am today. Now, thank you, Jane, for running through all those slides. To be honest, we could spend ages debating any one of those slides, but I thought for this mini section, I could just pick on one because it links really nicely with our first special guest, who is Patricia Vieira from KKR. Now, the one I'm going to pick is slide 8. And if you remember, that's the one that talked about whether people expect stronger or lesser demands for European real estate from institutional investors, essentially, in 2021. Now, Jane just called the results perplexing, didn't she? And she's right, because there's an even split. Some people think there'll be more, some people think there'll be less, some people think there'll be the same. Nightmare for journalists, maybe even worse for capital raisers like Patricia. Now, let me just, by way of introduction, let me tell you who Patricia is, at least from our perspective. First of all, she's too humble to reference herself like this, but she was actually nominated by our readers as one of 10 rising stars in European real estate this year. And we featured that this cast of 10 in our June edition, which everyone seemed to really enjoy. Now in June, Patricia was still working for Hines. She was coming to the end, actually, of an 8-year spell at Hines, where she worked in the capital markets team. In September, after the publication, I'm not suggesting there's a link, but after the feature was published, she managed to land herself a job at private equity firm KKR in its client and partner group. Now, both of those jobs that I referenced have something in common, and that is that she has frequent and direct contact with institutional investors and global capital sources, and has done throughout this crazy year. So I'm hoping she can shed a little bit of light on that question 8 of ours that we've just talked about. So if we can maybe spotlight Patricia, I think we want to see her more than me. Patricia, if we can really just ask, we've only got a brief spot together, so let's just ask a wide question. Can you give us a sense of the marketplace right now, given where we've come from? So for example, as far as fundraising is concerned, is it business as usual?
Hi, Robin, and thank you for the very kind introduction, and thank you to all of PropertyEU for inviting me today. It's a pleasure to be here. And Jane, I have to say, I found the results of your survey very interesting as well, and a couple of things struck me, and maybe we'll play that into our conversation here. But Robin, to your question, where is the fundraising environment? Where are investors today? Where have we come from? Well, I think, as you noted, back in March, when I was still at Hines covering European investors, the world stopped. Everyone took a pause, and it was really a time for fundraisers, I think, like me, to take a step back and say, this is not our moment to be bringing in new investment opportunities. This is time for investors to be able to look at what their portfolios look like, where the risks are, talk to our portfolio managers, to talk to all their managers across the board, understand how real estate fits into their broader portfolios and how that might have changed with the outbreak of COVID, and just understand where they stood. So I'd say for about 3 months, we were on pause completely for new investments. Then that happened, and as you know, real estate valuations move pretty slowly. So investors thought, okay, well, we know where we are, but we're not really sure where we're going. So there was a bit of a lull in terms of what was going to happen next. And jumping forward to today, I have to say, I think we are not fully business as usual, but we're pretty close to it. I often follow the Lazard snapshots, which they can circulate on a monthly basis. And according to that, about 70% of investors are back to business as usual. Now, I think you have to look at that in a bit more detail and see, which kinds of investors are back to business as usual. And also if business as usual means looking at the whole investor market or manager market, or if it means looking at the investors that and the managers that you've worked with before. And I'd say the reality is that sovereign wealth funds, wealth managers, family offices, groups that can be more nimble are certainly back to usual. And in fact, more than that, trying to take advantage of the opportunity, going to more value add and opportunistic plays towards managers that can, look at the whole continent, if we're looking at Europe, and all of the sectors, and really invest where the best opportunity is. And then we have a lot of investors who are just not yet ready to invest with new managers. And when I look at the question on next year, where will investors, or how much will investors be investing, and that's three-way split, I think it's not so much a reflection of the real estate industry, but perhaps of people's personal views on the vaccine and what that means for travel and what that means for due diligence in person, which I think remains a very important factor for a lot of investors. And maybe one last thing that I'll say is I've actually been surprised coming to KKR to see that we've had our most successful fundraising year ever. I think we raised a dislocation fund back in April, where we raised about 4 billion in 8 weeks. So it is possible to keep fundraising during this environment. And then I was also surprised to learn last week that we've had more meetings this year than in previous years. And we were talking about this earlier, and I think that the reality is without travel, you're actually able to fit a lot more meetings. And even though they're virtual, you do have, or I personally have, a lot more connectivity with my investors than I used to, because I'm not having to waste time on the tube, on a plane, traveling. So I speak to a lot more investors on a daily basis, and investors from across the globe. So I think there's pros and cons.
Yeah, and yes, exactly. And Patricia, before we get on to the investment side of things, which we will do in a second, just on what you said there, more meetings, you said, taking place. And yes, of course, it makes sense when we're using platforms like Zoom and others. But look, you're in that job there of capital raising, and you're of a certain generation. What do you actually think that the sort of the business of raising capital has therefore changed forever, or is this just a short-term thing?
That's a great question, and it's one I ask myself. The question was posed on a panel I was on a few weeks ago with people who have been in the industry a little bit longer than I have, and their response was, sure, perhaps it has changed to a certain extent. Maybe you won't fly halfway around the world for lunch anymore. I think that's not only to do with COVID and with the improvements in technology, but also sustainability coming up as a theme alongside that. So many reasons why I think those kinds of meetings won't happen anymore. However, I think there's a strong belief that in-person meetings will continue to be critical to actually making that commitment at the end of the day from the majority of the industry. However, I asked one of the associates on my team a few weeks ago the same question, and she's a few years younger, and said that in fact she did think that it was possible that in the future we'd go fully virtual, and that in-person meetings would no longer be necessary. When we make personal investments, a lot of us don't go out and meet the investment team in person. So I think it depends who you ask, and I am not sure what the answer is, but I think we'll be doing a lot more virtual work in the future.
Yeah, right. And you touched on it there. The answer may be very much linked to a sort of a generational thing, as you say. Now, turning to the investment side, what have we seen so far this year? We've seen, frankly, a slowdown in deal volume, haven't we? Obviously, this year. We've seen people that can't travel to see assets as freely as they would like. We've possibly seen a disconnect between sellers' valuations and what buyers are prepared to pay. And at the same time, as Jane mentioned in her presentation, we're now beginning to sense perhaps a level of distress deals that might be coming through, let's say from the beginning of Q1, Q2 of next year, perhaps. So there's a lot going on. Just again, a basic question: when you bear all these things in mind, and if you're working for a large global fund and firm that wants to be in real estate, I mean, is this really a good environment to be making investments in, would you say?
Yeah, good question. I think a lot of us expected there to be a lot more dislocation than there has been in our investment world, and there hasn't been. I think for me, not only did I change jobs, but I also had a break in between, and I thought by the time I came back in September, I'd see a lot more kind of distressed investing. However, that hasn't happened. You know, I should caveat all this by saying I am on the fundraising side, so I'm not speaking for our investment team. But you know, we've seen an acceleration of trends. I think I'm maybe a lot of people use this term, acceleration of trends, but I think it's true with logistics and residential becoming more and more popular. And retail, very few people being brave enough to touch it, and then office, you kind of have split views. I think the public markets have seen more dislocation than the private ones, and so for those of us on this call who are able to make such investments, there has been some opportunity to go there. But of course, we're mainly in the non-listed space, so it's not a huge exposure for a lot of us. And then, you know, going forward, what are we going to see? I think a continuation of investment into those major themes, logistics and residential. The big question I get from investors all the time, because KKR is also heavily invested in those two sectors, is how do you, as an opportunistic player, manage to get the returns you're looking for when the entire industry is looking at the same sectors? So I think we need to be a lot more creative, understand what our skill set is and how we can really do something that's differentiated to our peers. So for us, for example, that's taking a very granular approach to investing in logistics, for example, where we either working with operating partners or with platforms that we acquire, we go out and build up a portfolio of very small assets where we see less competition, and sometimes we can access deals on a more off-market basis. But you know, eventually all of these creative solutions may run out when you have the entire industry looking at the same space. So I think, you know, next year what we have a close eye on is probably hospitality, where we've been active in the past, and I think it was mentioned earlier, we might see some signs of distress coming through there. And then office selectively, as we get a better sense for how tenants are going to be going back once they're able to do so.
Exactly. And it will be interesting next year to see, let's say, what kind of model proves the most effective. We see these firms from our perspective with different models. You know, maybe your company is interested in looking at platforms to invest in or even buy. That your old company, for example, Heinz, your old shop, was a lot about boots on the ground in local markets, and they seem to believe that they can continue to generate deals through their local contacts, and then people have different strategies within that. So it will be interesting to see how that plays out. Eddie, I think we promised that we would field a couple of questions from listeners as they've come in. Yeah. I'm not sure if there are any, but maybe now's the time to put those to Patricia, and then I can wrap up with just one at the end.
Well, let me, there have been a couple come in. I'll keep it to one for time's sakes, and maybe if we've got a little bit at the end, I can throw another one in there. But one that has come through a couple of times actually is relating to ESG. So I'll try and summarize it in one question if I can. And it's how much more data do investors want on aspects such as greening their portfolio and diversity ratios among staff of the firm? So a couple of questions on the data on greening the portfolio, and another on diversity within the staff at the firm, as an example.
Yeah, no, that's a good question, and we do get an increasing number of requests on that. I'd say that the ESG topic has been on investor radar for 3-4 years. In a significant way. And I think the difference we're probably seeing today is that it used to come from the Dutch and the Nordics predominantly. And so you'd make sure that you could address it for those markets. Today, it's really coming from everyone, and not only from our investors, but also internally from the companies that we work at. I think everyone is trying to be better at ESG. And I think it's also no longer just about the E, but also about the S and the G. And in real estate, there's always questions about how we really do the S part of it, but I think a lot of people are putting a lot of thought into it. In terms of the data question, it's hard to answer here, but certainly when we're in due diligence with an investor, in almost all cases we get some sort of ESG questionnaire, and so we certainly fill that out. I think something that I'm personally seeing is those ESG questionnaires are becoming more and more adapted to real estate. At the beginning, we would see ESG questionnaires that were being used for private equity and that were just being transferred over to real estate. And so we saw quite a few challenges with that, because questions that were relevant in private equity were not relevant in real estate. And so I think it's great to see investors and managers working with organizations such as GRESB to try to really adapt those questionnaires to our industry, make sure that we're really providing what is meaningful data and also tracking for investors in our sector.
Thanks, Patricia. Interesting what you say about now investors are pinpointing their questions. It's not just a general thing that they've stolen from their private equity colleague to chuck at the real estate person. It's now tailor-made, which says it all really. So as we just wrap up now, two takeaways for our listeners. So they may either be working directly for real estate firms, or maybe their clients are real estate firms, their advisors. What let's say two things that people should bear in mind really going into 2021.
Mm-hmm. Yeah, I thought about this, Robin, when we discussed it previously, and I think is actually, I'll make it one thing because it's one thing I've learned and that I'd like to share here. From my experience, is it's networking, it's relationships. I think even though we are in a virtual environment, I mean, I've started my job fully remotely. I haven't met most of my colleagues. I think it's even more important now to stay connected with the industry. It's so easy to set up a Zoom call with anyone, regardless of whether they're based in London or Hong Kong or San Francisco. And I think, just being aware of what's happening, how people are thinking. The most creative ideas I've had since I've joined KKR have been, in the few just general catch-ups I've had with my colleagues, where you don't have a particular agenda, but you just hear each other out and come up with a creative solution. So I would say it's easy to just stay at home and do the meetings that you have to do, but just going beyond that, for me as a fundraiser, speaking to other fundraisers, speaking to people who are not even, not only investors, who are across our industry, I think is interesting. And maybe I'll just highlight one thing, which is that I was recently listening to the podcast that Emily Bohill's put together that highlights some of the, the founders in our industry. And it's incredible how every single story, there's a significant move that's made, whether it's the founding of a company or the execution of a huge deal, that comes across by a conversation they had at the bar or on the tube when they bumped into each other. And I think we need to have more and more of that creativity and have it maintained during these times where we're working virtually, so that we can invest better and just develop better relationships.
Yeah, I've listened to those podcasts as well. They're fascinating. I think there's one with Keith Breslaw at Patreon, who talks about how he really got his start when an investor from America came over, and the investor actually had a meeting cancelled or something, and he was at a loose end, and then just decided, oh, what was that funny sounding firm, Patreon, Keith something or other? Maybe I'll just look him up. Sent the email, whatever they did, probably just a call, and they met, and he was the founding investor in that company, and obviously where it is today.
Likewise, the other good one I just learned is M7 real estate is called M7 because it was 7 people at Expo Real during, I think, a difficult year. So they decided to just go to the pub and, just talk, and hence was founded M7 Real Estate. So
yeah,
I think
and now about to be sold, I understand, looking at reports.
Sounds like it.
coming full circle. Okay, listen, Patricia, thank you so much for your spot there. So insightful as ever. I'm going to hand back now to Eddie, if I may. Thanks again. Thank you.
Thank you.
Yeah, it's well, it's a nice segue actually, because Patricia was mentioning the importance of staying connected. So I will now introduce the opportunity to stay connected with the market via our editorial calendar. So allow me to introduce Sales Director Dean Ireland, who will run through briefly what we have on offer for next year from our magazine, our special publications, and our online information.
Thanks, Eddie. Okay, hello everybody, and thank you for joining us today. As mentioned, I will quickly go over the editorial calendar for 2021. Now, hopefully, you've got it up on the screen. You should be seeing the editorial calendar for 2021. Any aspects you want to discuss with us in any more detail, please do contact either myself or Eddie after this call. The calendar is worked up between the commercial team and the editorial team. Essentially, we want to do here is hit the big topics we know you are interested in. If there are subjects you feel we should be covering or putting more attention to, please do comment in the chat. Now, if I can draw your attention to the top, where we've got January 2021, this is where we like to work with investment managers, international property services, firms, brokers, developers, and other advisors, keen to share their views on what is transpiring in the market. A perfect spot for focus on thought leadership. We already have a number of submissions for the Outlook. Editorial team are collecting thoughts and are in the talks as to how to arrange this. It's not too late though to come on board, so I would invite anyone who would like to partner with us to contact us. As you can see in the special features for January, we will be focusing on leadership. The edit team is working on a cover story to do with diversity, in particular the rise of female leaders within the industry. Again, keen to work with as many companies as possible on themes of leadership to do with strategies and diversification. Other memorable inclusions, obviously ESG has been talked about a lot today. So many people have contacted us about ESG as an issue. You will see throughout the calendar there's emphasis on asset classes, for example, obviously residential, offices, etc. So I'll advise you to kind of review the calendar at your own time. We obviously feature top investors, all investment managers ranked by deal volume in June, whilst in October we rank assets under management. If we can just move on to the next slide, Eddie.
Yeah.
Okay, so right, well, it didn't come up there, but we do have two other publications. In effect, we have Retail Watch and Firestarters. Retail Watch is, sorry Eddie, the order's slightly off there. Retail Watch is about obviously retail developers, how they're adapting, and obviously the changing trends. So obviously for those who are brave enough to touch. Firestarters being all things tech and the disruption and advancements it obviously brings to the sector. Now, just go back to the daily news one there, Eddie, which I'm sure everybody's receiving our daily news, which of course links through to all the articles on Forward which are hosted on the website. All past articles are searchable through our archive, which is located in the research section of the website. Now, we've also introduced a weekly data sheet up on screen here. This is generally to help you keep abreast of the market developments and activities in a very concise and easy to review manner. Moving on from that, the final thing I'd like to mention is obviously we are the official producers of the Expo Real Daily News. I mean, we're looking forward to attending this year, let's say into 2021. And to be able to really come together with the industry and meet in person, hopefully in October in Munich. With that being said, I will pass you back over to Robin. Thank you, guys.
Thank you, Dean. Yes, back to me for our second guest spot. Now, our editorial team, as we've heard a number of times already actually today, our editorial team is hearing more and more discussion about the possibility of distressed real estate, being able to buy assets at very attractive prices potentially from Q1 and Q2 onwards. And already we've seen kind of conflicting, contrasting views. Patricia there mentioned that personally she's not seeing it, although she's deferring to also to her investment colleagues. We'll see to what extent KKR witness that next year. Jane Roberts referred to it in question 4 of our barometer when we posed the question, to what extent do you agree that next year will bring a significant number of deals at attractive or heavily discounted prices? And well, I mean, you can, the answer, it depends how you want to interpret. I mean, 10% strongly agree. They think they will see a significant amount. 56%, somewhat agree. You've got 28%, so almost a third do not agree. There won't be any next year. So I have no clue what's going on. And but I know a couple of people that might be able to shed some light on this in our second guest spots. So that's the aim of this next section. Okay, by way of introduction, over the last few weeks, I've spent quite a bit of time speaking to these two gentlemen who probably will pop up on your screen soon. John Amram of HPBA and Andreas Schulten of Bulwiengesa, who for the past 3 years have been producing what is really a unique study into off-market deals in Germany. Now, they'll explain in a minute exactly what they mean by off-market deals, but that in itself is a fascinating area, because if you're anything like me, I hear almost on a daily basis, hey, Robin, I've just done this great deal, you know, on behalf of my company. And of course, it's off-market. And I'm kind of wondering, what even does that mean? Does it even exist? So at the very least, we'll hear what the definition of off-market deal is. But more than that, their third study that they've just produced actually can put some data on the extent to which we'll see more deals or less deals happening in Germany, and what proportion of those might be off market. Also, by way of introduction, let me put it like this. John and Andreas caused a bit of a minor earthquake in 2018 when they published their first study, because no one could quite believe the volume of off-market transactions that they say take place every year in Germany. And they couldn't quite believe it, and it caused shock, because the figure that they came out with meant something quite profound, which is that many of the big agents were producing annual deal data that was frankly many billions, maybe tens of billions short of the actual real estate market taking place. And that's because they're not counting off-market deals. Okay, so it's from that place that we're going to speak to John and Andreas now. I'm not sure if we're putting them on the screen. No need to spotlight me anymore. Perhaps we can get John on, can we?
Thank you, Robin.
There he is. John, hello. Can you try and be brief if you may, because it's a long backstory, but can you briefly explain a little bit more about your studies, where they came from, maybe give that definition, if you can, of off markets, so that people actually know what we're talking about here first.
Sure. Thank you for the invitation. Well, basically, you know, I started the company about 12 years ago. And part of the method that we developed, or the key element of the method, is so-called off-market. Now, when it comes to the definition of off-market, we've tried to define it, and you can read it here, for the first study, which basically says that it's basically a trading from principal to principal without a broker, or in contrast to structured bidding process or on-market process. And I mean, let me actually define it differently. I mean, we have it here like this. This is what we have, the short version of the study here on the sheet. But I would just to expand on it a little bit. It's principal to principal direct trading of properties, principal via broker to principal real estate trading, as well as accessing a very small select qualified group of maybe 5 or 10 investors exclusively. So much for the definition. The idea for the study came about around about 4 years, 5 years ago, because I would hold many discussions with investors, and I would try to highlight the various benefits of actually going off market for a potential sale. So I would set up different theses and say to people, look, at least our experience was showing that we would achieve higher success ratios, greater discretion, flexibility, that you would have a greater access to investors, like to a broader spectrum of investors. And in many cases, in fact, you would have even the possibility of achieving better prices. So the response was, well, John, that sounds really great, but can you prove it? So a few years ago, I sat together with Bulwiengesa, who's Germany's most respected research company, and we decided to develop the study. So, you know, we wanted to create some transparency, highlight the characteristics of off-market deals, and at the same time, you know, look at the potential size of the market, which no one had actually done before. So as you already pointed out, the number was quite surprising because we came to a number of about 40 billion. And so, you know, this was quite heavily discussed in the market. And maybe what I will do now is just ask Andreas to say a little bit more about the actual size of the market and how this number came about and why we think that this is in fact the correct size for the definition of the overall transaction size or volume in the German real estate market.
Yes, thank you, John. And Robin, you already made our audience very curious on this. Well, we say 40 billion compared to 70 billion on the professional market, because in Germany we have something which the UK and also France, and I think also the Dutch don't have. We have that registry which really counts every single transaction, so every single asset deal in Germany, and we found this, you know, spread of numbers and thought, well, what is this really the amount of off-market? And you know, John, that we were quite happy when you stepped forward and asked us to provide you with these studies, because off-market really is, as you said, Robin, is so cool. You know, when you're really a good investor and good in developer, you say, well, I did this off-market. And we, as transparency fans, wanted to look behind the scene and, you know, look this up. So we say off-market is, at least in Germany, by far not a niche market. It is really a big market, as we say, 40 billion compared to what we say up to now, 70, 80 billion or so on the professional market. But this year, and now this is the other thing you pointed out, Robin. So this year we asked two things. Will off-market have a bigger share in this year, 2020, and next year, 2021? And also the question on distressed deals. So one thing, yes, in our survey, so we had a response of 149 people and really good investors, good developers responding on our survey. So 54% are of the opinion that the off-market transactions will have a rise, and only 50% think that 15% of the participants think that the professional and institutional on-market will have a bigger ratio. And that was one thing. So we have a slight decline also in investment in Germany. So that is the case also in Germany. But the ratio of off-market will probably be a little bigger than it was in recent years. And the other thing, we ask for distressed sales, and this is what the lower figures say. So 67% of our survey of our panel said that distressed deals will rise after COVID-19. And only the comparison is only 30%, a little more than 30%, that there will be no change in distressed deals. And this is what Jane and Patricia also stressed. So everybody is looking for opportunities, and these are good numbers, we would say, that not only on the professional market, but also in this kind of, other market we have, probably also in the UK and France and other European countries, that distressed deals might be a real big issue in this kind of special market, in this kind of off market. I mean, this is what we say. Whether you, John, would like to close what we find out, is this really going to have an advantage to deal off market in comparison to the bidder processes and the platforms of the brokers?
Well, I think the results are related. So I'm not, I mean, maybe one thing regarding the distressed sales. Just recently, Dr. Linnemann, who's the president of the German Mittelstands- und Wirtschaftsunion, which I think translated means SME and Economic Union, he basically said that Germany is not under threat of a wave of insolvencies. He said it's a fact, it's coming next year. I also recently met with a few politicians who expected something like 60 to 70,000 insolvencies in Germany. So that's quite a massive number. I was quite struck by the, we almost had exactly the same numbers there with a 66 or 67%. But, off-market increase with regards to, the relation to an increase in distressed sales makes sense, because obviously you're more discreet when you're selling off-market. And in uncertain economic times, investors as well as financing banks are much less reliable partners. So it's more important to have a highly qualified investor, which is who is much more easily found through a intelligent off-market method. So, so I'm not too surprised. I think that might make sense. In addition, in our second study, we also could show that around about 30% of investors categorically decline to take part in bidding processes or on-market processes, and whereas about 97% are pursuing off-market transactions. So you're basically able to access a far greater spectrum of investors when, if you're looking to sell off-market. So I think this kind of explains maybe some of these results. And yeah, so the question is now if this can be translated into other markets. Of course, we've asked German investors, but potentially this might also hold true for other markets in Europe.
Yeah, it's fascinating. Now, your studies are very comprehensive. It would take us hours to go through each part, and fascinating. In fact, we have spent a couple of hours in recent weeks talking through all these things. It's fascinating. If I could just pick on one thing, it's what you call the price delta, or in other words, a premium. Now, you've asked many people their opinion. If you're a seller, would you think that you would get a premium for entering into an off-market deal with a buyer? Or in contrast, if you're a buyer, do you think that you should actually get a discount for entering into an off-market deal? Now, I've seen your data. It's kind of hard to interpret because it seems like no one's quite sure. Sellers think it's to their advantage. Some buyers think it should be to our advantage if we're getting involved with you on an off-market deal, especially if you want to keep things quiet, right? We should be getting some sort of discount to reflect that. Now, tell us about that and try and put some data on it, because your studies actually tell us the level of discount or premium that people think is acceptable.
Yeah, it's a great question. So, let's maybe go, let's look at real deals. So like you already said, somebody calls and says, oh, I just did an amazing off-market deal. When they say amazing, they mean they're really happy because everything went according to plan. They probably had a great price. And in most cases, when they say that, I would suspect that, it was a principal to principal deal where somebody's basically activated their network. It's somebody they know, and there was no competition, as compared to, for example, bidding process where you're one of, say, 100 people. So statistically, of course, you've got a much lower chance of being successful. And so that could potentially explain why an investor will be happy to do an off-market deal and at least expect some degree of discount perhaps, or like a good price, a decent price. But it's not the only factor. The other factor is that, you know, the probability of success is so much higher because you have less competition. You're not binding yourself with, you know, due diligence costs, you know, human resources, opportunity costs, and, you know, these costs can go into the millions. And if you're unlucky, you've basically wasted them. Now, on the other hand, if you are a seller, we've seen this at least at HPBA, that we've often achieved above average prices. And the reason for that is that if you're talking to a very select group of investors, investors are very happy if the numbers work, to pay a premium for deal exclusivity, which means you're actually buying yourself. You know, you're able to pay a few % more because you want to eliminate the competition. So you'll say, okay, you know what, in order to have this privilege of being able to complete the deal, I'm happy to, you know, maybe add another 3 to 5%. And I know that, you know, I have deal security. So both holds true, and it basically depends on the circumstances and the way that the deal was actually sourced in the first place.
Yes, fascinating. And one other question, which I think people need to be aware of, as far as your findings are concerned, when it comes to off-market deals, well, I told you myself, I hear this many times, but they tend to be from international investors in a particular country, you know, as if they're going to the Wild West and, you know, they really managed to dig out something special. As far as you're concerned, are these off-market deals, and you said it yourself, there's 40 billion a year happening. Are these being done by international firms, private equity firms, or is it more of a domestic market? That's question one. And question two, are there particular asset classes where you have detected a trend towards off-market deals?
Well, actually, we were a bit surprised too that, you know, the study showed that it was mainly local players, you know, funds, project developers, and so forth that were the most likely actors. The second question was?
Asset classes. Are there particular asset classes that people gravitate
right.
towards?
Yeah, exactly. So, and in the past, you know, people would say, oh, it's just like a niche, you know, market, and it's probably more complicated types of asset classes, you know, that are being sold off market. But the study actually showed that the majority of deals are being done in the commercial field, in offices. I think it was about 38%. And Resi was a very close second with Andreas, please correct me if I'm wrong, I think it was 34, 36%. So it's basically the most common asset classes, and the players are mainly local players. It's also international investors, but it is it's pretty well anchored in the local market. So I would say both holds true, but it's not necessarily so many private equity companies that are coming from abroad into Germany and so forth. So which you know, surprised me a little bit, because my experience shows that they do like to buy off market, you know. But
Yeah.
perhaps they're just a little less successful because they're not as well connected or networked as a local player might be.
Yeah, which goes back to Patricia's comments right at the end. If there's one key takeaway, it's all about working those contacts in your network. So important. Look, with that, again, Eddie, if there are questions that have come in, now would be the time to ask it of these gentlemen. I mean, I can think of one straight away, but Eddie, have we got something that we?
Yeah, look, let me wrap it up into two. I think, to be honest, John and Andreas answered the first one, which has come in, which was, is there, I mean, it's a great study for Germany, but is there a possibility of similar off-market studies for other countries, and have you seen it being done? And I'll follow that up with the second question which has come through, which is, what size of deal and asset class do people tend to prefer for off-market transactions? And perhaps you've covered that already as well, but if you could summarize those 2 points briefly, that would be appreciated.
Andreas?
So in terms of, yeah, John, sorry. When we come to other countries, yes, we are linked. Bulwiengesa is very intensively linked to PMA, property market analysis, and we talk with our colleagues. Could this be done also in the UK? as I said, we don't have the same kind of registry which we have in Germany, so that makes it a little harder to really dig down. But we are happy to share our experiences we had in Germany over the last 3 years with John's company HPBA to continue this kind of work all over Europe. But yeah.
And the average size?
Yes, size of deal and asset class.
Well, average size is well, maybe average size in our survey was, I believe, I should also look this up, is something. What was it, John?
I think around 50 to 70 million or something.
It's not that big. It's below 100 million, definitely. And it's and when we come to asset classes, I mean, that is what we had earlier. It is office and residential and all others, like in the professional market. What is important is that we have a big share of developers who use off-market in order to grab opportunities in terms of land and schemes, and that is something which might be interesting to the audience as well.
Okay, Eddie, there are two questions. I don't know if you spotted this.
Yeah, I've spotted them. So I think we've probably got time for one. So let's go for the top one, which I will pass over to you as well. So how do you demonstrate to shareholders, investors, that price discovery was realized, i.e. prices were maximized without a process, and surely you can't. Can you speak to that, please?
John, your turn.
This is a discussion I hold a lot. I mean, we argue. I kind of suspect that everyone knows what their property is worth because you've obviously done an evaluation. So I understand when they say, okay, we are doing a structured bidding process, and the perception is at least that you've invited everyone. And therefore, you should have achieved the best result. This is kind of like the argument that comes from investors who are selling in this traditional process. But we know from experience, so it's very hard to prove, by the way, right? So it's because no one is really going to tell you exactly, or it's a very theoretical question that's hard to answer. But we know, for example, that we would have, and this is just my own experience, of course, this has nothing to do with the study, that certain sales have taken place, but we knew that there were investors out there who would have been able to sell, to pay a far better price. This also happens. So I see both sides, but unfortunately, it's kind of hard to prove, whether you've achieved the best price possible or not. Now, it also depends on the off-market transaction process that was actually being conducted. And this is very individual. So, you can't really prove, or I mean, I would actually pose the statement and say, you know what, if somebody is dealt directly with another party without there having been a pre-qualification process, then you probably might have not achieved the best price if you've done it, say, principal to principal. But you don't really know. It's also possible that that other party has paid an excellent price, but it's very hard to prove. However, there's also off-market processes that basically utilize a pre-qualification process, which also looks at usual as well as unusual suspects, and they could also number 50 to 100. However, in the end, you only have 5 or 10 that are actually being offered the property, maybe even 3 to 5. So, the question is very intelligent and it's very, very legitimate, but the answer is not an easy one.
No, and John, just to follow up, if I can get away with this one more, which is linked. I mean, surely there are times when you would advise sellers, or sellers have to be, it's a no-brainer, they should actually run a competitive on-market process. Surely you've been in that situation where you've had to say, yeah, you know what, that's the way to go with this. Like, what are the circumstances where that would be the right advice?
Well, I would normally advise that on properties that might be a little more complicated, because people sometimes feel that off-market brokers, for example, they know the unusual exotic investor, who's paying the highest price, and this is not really the case. But again, it depends on the method. So, you know, certainly bidding processes have their place. They need to be also in the market, because not every investor is able to act dynamically in an off-market transaction. Let's take an institutional investor, an insurance company that basically need 2 to 3 months in order to get from A to Z, as it were. And if you were to call such an investor, depending on the process that you're obviously managing, and you're telling him that you need to be dynamic, you need to be able to get the drafts of contracts within 3 to 4 weeks, or whatever the case may be, they may struggle. They may not actually be able to, because they have investment committees that only meet, say, once a month or once every 8 weeks, and he's already out, right? So, but it goes both ways, you see. So there certainly is space for bidding processes. I think what I would wish for the future is bidding processes that eliminate some of the disadvantages, that basically allow investors or give investors a higher probability of success, which off-market methods can do.
Great. John, Andreas, thank you so much. Let's close it off there. Back to you, Eddie, for a wrap-up, I guess.
Yeah, so look, thanks a lot for that, guys. It's much appreciated, all that information. And I know certainly from the questions coming through, there was a lot of interest in what you're doing. So look, I just want to briefly, and I will be very brief because I appreciate we've run over time. Can you all see the screen there, the screen being shared? It's all come up, yeah, great. So look, just to cover off on our events. So PropertyEU have been running a series of events over the past couple of years, which have been slightly different than what you may have seen across the board with a lot of the Zoom webinars and things like that. Because what we've done is we've actually had these private roundtable discussions, which we've then been able to produce into some really, really good and interesting content to be reproduced across our daily news, across our YouTube video channel, and in our magazine. If you look on the right-hand side, we ran a series in September. And if you had access to the October publication this year, you would have seen the full reports on those through that function. If you don't, what I can do after this discussion is send you through all the documents that we have presented to you today. But long story short, we produced 3 roundtable events, as you can see from the thumbnails. 2 of those were virtual, and one of them we did manage to sneak in a physical event, socially distanced, of course, here in our headquarters in Utrecht, and it was nice. It was really great to have that connection, albeit from 1.5 meters distance. What I wanted to just refer to is what's coming up next year. So again, we're a little bit unsure about what the world is going to look like in 3 months. So I think it's fair to assume that it'll be still a little bit light on the possibilities of travel. So we're going to run a March series, as you can see, which will be virtual, okay, and that will cover off, as we've heard a lot about today, ESG and sustainability, and we have a number of guests already lined up for that who will make that a very interesting discussion. And following that, you can see the innovation and PropTech, office outlook, investment in Central and Eastern Europe, and investment in the UK. Further down in September, we repeat a couple of the discussions we had last year and add a few more in. Of course, if we get back to Expo Real and to MIPIM and MAPIC and all of these other events, we may well run some panel discussions in conjunction with those fairs. But like a lot of you here, it's all a bit of wait and see. What we can guarantee is that we will have these discussions over this period next year. So if you are interested either in reviewing the content or actually participating in the discussions, then our contact details are below, and I will send this through to you as I mentioned earlier. So thank you for that. I do appreciate that we have run over by quite some way, but I think hopefully you all agree that the information and insight we got from Patricia, from John, and from Andreas was well worth it. And I know Patricia's had to shoot off to another call, and I'm sure a lot of you attending probably have multiple more Zoom calls to do this afternoon. So I will, on this note, just thank you all very much for, not just for today, for attending today, but also for your support of PropertyEU over the course of the last year. It's very much appreciated, and I think Robin will concur that you know, the feedback we get from you is very, very insightful. It's very informative and it's well regarded. So please keep sending it through. We'll keep sending you, you know, barometers and all the rest to try and keep the engagement high. And look, we look forward to hopefully being able to meet each other in person at some events next year. But for now, have a great Christmas, have a happy New Year, and bring on 2021. Thanks, everyone.